Well, actually, I think the formula on any company is pretty simple. You have revenue minus costs, it gives you the bottom line. Superficially looking at that, this has been a clear beat. So some of those components have clearly worked out the way one was looking into or hoping and even beating. So I think on the surface it looks like an outstanding result, which was everyone's hope, and clearly better than what was hoped for in first instance. This is even more important given that UBS took over Credit Suisse, and there the revenue and the cost sides are even more challenging, and the implementation of the transition plan is an element that comes on top of it, and which is scrutinized by the investors as well.
Going forward, however, some analysts this morning raising concerns about the outlook for global wealth management as well as personal and corporate banking. Do you share that concern?
Yeah, I think if we then dig into the revenue component of it, clearly what's a very big structural beat is the net new assets. Yeah. 27 billion, equal as the first quarter. And if you take into account 6 billion outflow in US tax revenues, which are cyclical and seasonal, it is clearly a beat, and it's all over the world. So trust came back. That's clearly a very good thing. That, if we then look into the different divisions, what's a bit disappointing is that the revenue generated comes from the more volatile components of the company. And I think that is something that one should be concerned about to bring up the revenue in the more recurring elements of the bank.
Naturally, also because we're expecting new capital requirements on the bank. We're waiting to hear from the authorities here in Switzerland. How much of a problem is that for the future of UBS? Do you think that based on these latest figures, they're actually in a position to, be okay with a potential $25 billion additional requirement on capital?
Well, I think given the knowledge that will potentially be there, the bank has already prepared. In the end, that's a good thing for clients and investors if it is there. It's only the speed of implementing that's going to influence the profitability of the bank, and also the return to shareholders in the short to medium term. Not having any clarity on that is clearly a component which makes the investors a bit nervous, and it's a very political element specifically for Switzerland. This bank is almost too big to save, so one wants to be sure that there's enough buffer there in case that the weather turns sour.
Now, it was quite positive to hear that they have started their share repurchase program. However, when you think about the upcoming years, and they've guided for stronger share buybacks in the future, is there a risk that they might not be able to deliver on that front, given these potential new capital requirements?
Well, it could be, but at the same time, if there's less shares being bought back and it's compensated then by better capital ratios because of the buffer, I think all in all, share price-wise, that shouldn't have too much of an influence. So yes, it would have a short-term impact on either dividend or share repurchasing, but in the long run, I think that will be compensated by the quality of the balance sheet.
Now, UBS has been compared to Morgan Stanley, as this is the European version of Morgan Stanley, perhaps. Do you think that the bank is indeed in a position to actually compete with the big US players?
I think they are. They're not just a European player, but if you look at its footprint in Asia, for example, this is truly a global bank. And I think that's something that needs to be looked at. Of course, they have their, between brackets, retail part in Switzerland, and that's very crucial for the Swiss economy. But all in all, this is a global player and can indeed compete with the bigger players out there.